So, Larry, inflation back in the news again this week. We've talked about it quite often. What did you make of these CPI numbers? I know that some people said, although the headline number was a little bit alarming, the core number, not so much.
I think these numbers are very disturbing. People have been cherry picking their favorite indicator in order to say everything's under control for months now. And they did it again, most notably Paul Krugman did it again this year. The one everybody liked on Team Transitory 3 months ago, which was the so-called trimmed mean or the so-called median inflation, which basically took the central component, those numbers were on fire last month, showing major acceleration. Look, we're seeing exactly what you would have expected with a central bank behind the curve. We're seeing an explosion in particular components and bottlenecks, giving way to a more generalized inflation. We saw it in specific components early a few months ago. Those components have receded a bit, but now we see inflation becoming more widespread in a wider range of products, spreading to the housing and labor markets. I've been alarmed for a long time, and I'm more alarmed now.
So, Larry, if in fact inflation is the problem, or at least something we should be addressing, what should the Fed do about it?
They should taper faster than they're talking about. I don't get why anyone thinks there's a need for another $400 or $500 billion in bond purchases in an economy where the Fed funds rate is running at -4% in real terms, in an economy where we're running very, very large budget deficits, in an economy with a record degree of labor shortage and quits. Tapering should take place in 3-4 months, something like that, and it should be clear that the Fed is ready, if it's necessary, as looks likely, to be moving to tighten much sooner than they've currently talked about.
Larry, this week you gave some remarks criticizing the Fed, I think it's fair to say, for getting distracted, being too worried about things like climate change and inequality. What sort of reaction have you had to that? Adam Posen, for example, from the Peterson Institute, has sort of criticized you for that, saying, no, actually the Fed's not doing enough about climate change.
Look, I think that the Fed's job is to manage money. The Fed's job is not to make a broader society and more just society. That's the job of elected officials. That's the job of the political process. If there are real and genuine financial risks, that should absolutely be part of the Fed's regulatory mandate. But I'd much rather have seen the Fed preserve the regulations it had than the ones Governor Quarles have loosened, than see it trying to use regulation as a hook to connect itself to the climate change problem. I think that's the better approach. I think the Fed should stick with its responsibilities for macroeconomic performance. And when I see it start to broaden much more widely to social justice or to climate issues, I get nervous, especially when I don't think they've got it under control on their core responsibilities of sound money and low inflation.
And where does that intersection come? I mean, the Biden administration this week, at the end of the week, also came out with a sort of an overall blueprint. It's not clear what the details are, saying we have to address climate change. And one of the issues is financial system resilience. It's not clear whether that applies to the Fed as well, but where is the intersection where actually climate is a matter of financial strength and stability as opposed to trying to change society?
We'll have to look at what the recommendations are. If you're an insurance company and you're insuring homes that are at more risk of flooding, then you absolutely need more reserves. If you're a bank and you're making loans to energy companies that aren't actually going to be able to market their energy, that's something you certainly need to think about when you regulate the bank. But I don't think that going beyond that to try to limit the flow of capital into the use of energy is necessarily the right thing to do. And I have some concerns that at a moment when we're seeing spiking energy prices, and those spiking energy prices are doing a variety of kinds of damage, including to some of the poorest people in the world, the general idea that the thrust of policy should be to deny financing to fossil fuels makes me pretty nervous. I'd rather see more emphasis on reducing the demand for fossil fuels than reducing the supply of fossil fuels. I don't think it's healthy that we're seeing the kind of spike in energy prices that we've seen, and I think that's an important near-term concern.
Another event this week was the annual meeting of the World Bank and the IMF in Washington. Looking at what was discussed, what got done this week, what do you say about the way that these international institutions are responding to some of the global challenges we face?
You know, frankly, with the United States preoccupied by domestic issues, with some of the issues of internal governance in the international financial institutions, with the splits between the United States and China, I have to say it's a bit tepid. I don't think we've seen anything dramatic on the climate change challenge. I think we're still not yet committed to do what's necessary to protect the world against future pandemics. And so I think we marked time a bit this week, and I hope we'll see more boldness in the future. I'm glad to see Kristalina Georgieva continuing her leadership at the IMF. The SDR steps were constructive, but I think we really need more boldness, and that really depends upon the shareholders of the major institutions, starting with the United States.
Hitting a little closer to home, we got some reports from some university endowments this week, including from Harvard, that you're very much identified with. You're not only the Harvard professor there, but also, of course, the former president of Harvard. Harvard didn't do so well. What's going on with that?
Look, endowments are invested in some kinds of stocks or others, and they've gone way up. It's good news. The post-COVID austerity in higher education, there's no need for that on a continuing basis. Universities have billions of dollars today, more than they could reasonably have expected to have today before COVID started. So it's a time when they can invest in distance education, they can invest in providing more opportunity to more disadvantaged people. It's a time when they can invest boldly in science. I do think we at Harvard, whose performance has lagged for a substantial time period, the people who are currently responsible for that do need to do some soul searching on why that's taken place and try to set it right, since it's cost the university billions of dollars.
Okay, let me sneak in one more. Should they start investing in Bitcoin? Because that was very much in the news. That did not mark time this week on news that the SEC appears to be about to approve ETFs for futures in Bitcoin. Where is that going?
Look, I think the right regulatory framework for Bitcoin is that we regulate Bitcoin for all the things we regulate the rest of finance, whether it's money laundering or suitability of consumers who are investing or market manipulation. I don't think we should turn Bitcoin into some paradise of regulatory arbitrage. I also don't think we should be punitive for the sake of being punitive with respect to Bitcoin. We should regulate it as we regulate other pieces of finance and then let the market decide what its functionality will be.